Matt Kevin thinks the AI sell-off is over, but I see a bigger risk here. Hey guys, welcome back to my channel. So let's start now. The AI stock sell-off may be over. At least that's what many investors are starting to believe right now. Recently, I watched Matt Kevin's latest analysis about the AI stock market sell-off, and his argument was very interesting. Kevin believes that the recent pressure in AI stocks was mainly caused by forced selling and excessive leverage. Not because the artificial intelligence story itself is broken, his argument is simple. A major AI focused hedge fund faced a massive liquidation after taking highly leveraged position. Because of that, the market experienced a wave of forced selling. And now that this pressure is reducing, Kevin believes the market could stabilize and potentially move higher from this point. And honestly, there is a one part of this argument that I agree with. Leverage can create artificial selling pressure. Yes, when investors use borrowed money and aggressive position, even a temporary decline can turn into a much bigger market event. But I think investors need to ask a much bigger question from here. Was this only a leverage problem? Or are we seeing something deeper happening inside the AI investment cycle? Because removing one seller from the market does not automatically mean every AI stock is now a good buy. And today I want to explain the biggest risk that I think many bullish AI investors are ignoring right now. So, first, let's understand what actually happened here. The most important point from Matt Kevin's analysis is that the problem was not necessarily artificial intelligence itself. The problem was leverage. When a fund takes extremely large position using borrowed money, a normal market decline can become dangerous. Prices start falling, investors receive margin pressure, positions are forced to be sold, and suddenly the market moves much faster than the actual business fundamentals. This type of selling creates fear and can push stock lower than where they might normally trade. So yes, I agree that forced selling can create temporary market pressure. And when that pressure disappears, market can recover. But here is where my view starts to differ from Kevin. The end of forced selling does not automatically mean the beginning of a new bull market, because the biggest question for AI stock is not, are investors done selling? The real question is, are AI companies still growing fast enough to justify their current valuation? This is the important one, because stock price are not only based on today's earnings, they are based on future expectations, right? And right now, AI expectations are extremely high. Companies like Nvidia, Microsoft, Google, Amazon, Meta, are many other have invested hundreds of billions of dollars into AI infrastructure. The entire AI investment story depends on one major assumption. The AI demand continues grow at an incredible speed. But what happens if that growth rate starts slowing down? What happens if companies being reducing their AI spending? If you think this is just a theoretical risk, just look at what's happening in the market today. On one hand, Amazon stock surged 12% because their AI driven cloud business is booming. But on the other hand, Apple stock got rejection between 7% to 9% simply because their forward growth guidance failed to satisfy lofty investors' expectation. This massive drop from Apple proves exactly how sensitive the market is right now to future outlooks. That is the risk investors need to watch very carefully. Because right now, the AI ecosystem works like this. Big technology companies spend billions of dollars building AI infrastructure. They buy advanced chips, they build massive data centers, they expand cloud capacity. And companies like Nvidia, then TSMC, Broadcom, and many, we can say that the memory manufacturers benefit from this demand. But the market has already priced in a lot of future growth. So the question is not whether AI is real. AI is absolutely real. The technology is changing the world day by day. The question is, can AI growth continue at the same speed that investors are expecting? Because if Microsoft, Google, Amazon, or Meta slow down their AI capacity spendings, the impact will not only hit one company, it can affect the entire AI supply chain. We can say that. Chip demands, memory demands, data center growth, and future earning expectations. And this is one area where I think investors need to be very, very careful. Many investors assume that eventually AI chips price will come down and that will help AI adoption. And that is true. Yes, lower price can increase demand, but investors need to understand something very important here. Lower prices are great for customers, but they are not always great for suppliers. For companies producing the hardware, lower prices can create pressure on profit margins. Right now, one reason companies like Nvidia have benefited so much is because demand has been extremely strong and supply has been limited. But if supply increase and competition becomes stronger, profit margin can start normalizing. And when margin normalize, investors may start questioning whether current valuation are justified. Another major point in this debate is interest rates and the bond market. Yes, Matt Kevins believes that the bond market has already tightened financial conditions significantly. His argument is that higher bond yield have already done part of the Federal Reserve job, meaning the Fed may not need to be more aggressive now. But I think investors should also consider the other side of of this argument. High bond yield are not automatically bullish for stocks, but this is the reality Kevin is missing. The 10-year treasury yield is currently sitting evaluated by, we can say that, 4.72%. And because of rising geopolitical tension, Brent crude oil is trading around like $89.40 a barrel. So while Kevin believes the bond market has already done the fat job, this high yield and energy pressure means financial conditions remain incredibly tight here, especially for growth stocks. Because higher bond yield means higher borrowing cost, more expensive financing, and lower valuation for companies whose profit are expected far into the future. And many AI companies are valued based on those future expectations. So investors cannot ignore what is happening in the bond market. Now, after looking at Matt Kevin's argument and comparing it with the bigger AI market picture, my view is I don't think Matt Kevin is completely wrong here. The leverage problem was real. Forced selling can create temporary market distortion, and removing excessive leverage can definitely help market stabilize. But I think investors are making one mistake. They are confusing the end of forced selling with the beginning of guaranteed AI rally. And those are two complete different things. The next major move in AI stocks will not be decided by one hedge fund liquidation. It will be decided by earnings, by AI spending, by profit margins, and whether these companies can actually deliver the massive growth that investors are already expecting. The AI story is not dead, but the market is not entering a phase where expectations are extremely high. And where expectations are high, even good companies can struggle if they fail to beat those expectations. So the question is, do you think this AI sell off was just a temporary leverage problem, or are we seeing the beginning of a bigger valuation asset? Let me know your opinion in the comments. And if you want more videos where we analyze the biggest Wall Street opinion and test them with real data, make sure to like and subscribe, guys. Thank you so much.